years, the U.S. economy has stood as the envy of the world, with soaring GDP, robust productivity, and impressive wage growth. America seemed untouchable. Inflation, which had surged to alarming highs, had even cooled to a manageable 2.4% by September of last year. Yet, in a shocking turn of events, cracks are now appearing in the economic foundation. Consumer confidence is plummeting, the trade deficit is expanding at a troubling rate, and inflation is proving to be a stubborn beast. Is the U.S. economy heading toward a full-blown crisis? The latest real-time GDP, now forecast from the Federal Reserve Bank of Atlanta, paints a dire picture. The estimates suggest a jaw-dropping 2.8% contraction in GDP for the first quarter, a stark reversal from the growth that had once defined America's economic landscape. While official data will be released in a matter of weeks, this early projection has sent shockwaves through financial markets and economic circles alike. But what is driving this sudden downturn? And could it all be traced back to President Donald Trump's return to office? Since taking the reins again on January 20, 2025, Trump's administration has embarked on an unpredictable and erratic economic course. His approach to trade has been particularly destabilizing, with abrupt tariff implementations and reversals sparking chaos in global markets. This uncertainty has been costly. Wall Street has shed a staggering $3 trillion in value, a direct result of jittery investors reacting to erratic policy swings. The Federal Reserve, facing mounting instability, has opted to hold interest rates steady, recognizing the deep economic uncertainty arising from abrupt shifts in trade, taxation, government spending, immigration policies, and deregulation. For ordinary Americans, the picture is even bleaker. Inflation is making daily necessities increasingly unaffordable, squeezing low and middle-income families and forcing them to tighten their belts. Consumer spending, the backbone of the economy, is showing worrying signs of contraction, exacerbating fears of a looming recession. The labor market is also sending mixed signals. February's job numbers, Trump's first full month in office, came in well below expectations. While employers added 151,000 jobs, the figure fell short of the anticipated 170,000. Though the unemployment rate remains historically low at 4.1%, underlying weaknesses cannot be ignored. The federal government, under Trump's directives, slashed 10,000 jobs in February alone, a trend that is expected to intensify. With tens of thousands of federal workers already facing termination and more cuts looming, what will be the long-term impact on economic stability? One of the most alarming developments has been the rapid deterioration of the key economic pillars that sustain GDP: consumer spending, private sector investment, government spending, and net exports. The sharpest decline has been in net exports, a consequence of a massive surge in imports without a corresponding rise in exports. Businesses, anticipating even harsher tariffs, have resorted to front-loading, stockpiling goods now before tariffs make them prohibitively expensive. This rush to import has skewed the balance of trade, deepening the deficit. Compounding this issue is the relentless strength of the U.S. dollar, which, while making imports cheaper, is making American goods less competitive on the global stage. Yet, the most ominous signal comes from the collapse of consumer spending. For years, robust consumer spending has propelled the U.S. economy ahead of its peers. However, data from the Atlanta Fed now suggests that consumer spending growth has flatlined, falling from around 2% last year to near zero today. Surveys from the University of Michigan and the Conference Board reveal a steep drop in consumer sentiment, with inflation expectations hitting their highest levels since 1995. These surveys indicate that Americans are bracing for further economic turmoil, and ominously, the Conference Board's expectations index has slipped below the critical threshold of 80, historically a harbinger of recession. Business confidence is also unraveling. The ISM Manufacturing Index has revealed a stagnating manufacturing sector, only propped up by the very same front-loading that is destabilizing trade balances. Meanwhile, the spending power of ordinary Americans is diminishing. According to Moody's, The wealthiest 10% of Americans now account for a staggering 50% of all consumer spending. This means that while the richest continue to fuel some economic activity, the vast majority, 90% of the population, is already experiencing the financial strain of a recession. This imbalance makes the economy highly susceptible to stock market fluctuations. When the wealthiest Americans reduce spending due to declining stock values, the effects ripple across the entire economy. With markets already shedding trillions, could the next crash be imminent? To be fair, not all of these economic woes can be laid at Trump's doorstep. Some of the recent slowdown is a natural consequence of the depletion of pandemic-era savings, which have fueled consumption over the past few years. However, there is no denying that Trump's trade war rhetoric and tariff threats have played a major role in eroding confidence. Consumers and businesses alike are expecting higher inflation, further dampening sentiment. The political implications are striking. Polling data shows that Trump's economic approval ratings have taken a nosedive. Once a pillar of his popularity, economic stewardship is now one of his greatest vulnerabilities. Recent surveys indicate his net approval rating on economic matters has plunged to -12, the worst of his presidency so far. Inflation remains another persistent menace. Since bottoming out at 2.4% last September, it has steadily climbed back to 3% in January, with Trump's tariffs likely to push it even higher. The Federal Reserve, which had been considering rate cuts, may now be forced to rethink its strategy. The White House has already begun attacking the Fed, with figures like Elon Musk joining the chorus. But if inflation continues its upward trajectory, pressure for further rate hikes will intensify, risking further economic contraction. Then there is the national debt. Trump's campaign was built on the promise of tax cuts without any clear plans for spending reductions. As a result, fiscal discipline has taken a backseat. Hopes that the GOP would offset tax cuts with significant budget savings have evaporated. Even their own projections admit to only shaving off a negligible amount from the federal budget, while the most recent Republican proposal, endorsed by Trump, adds a colossal $2 trillion to the deficit over the next decade. U.S. borrowing costs have remained low for now, thanks to investor demand for safe assets amid economic uncertainty. But how long can the U.S. keep borrowing at this scale before it triggers a full-blown debt crisis? The writing is on the wall. The American economy is standing on shaky ground, and the warning signs are becoming impossible to ignore. Plunging consumer confidence, declining spending, a widening trade deficit, policy-induced market instability, and the looming threat of inflation all paint a picture of an economy teetering on the edge. If current trends persist, could the U.S. be on the verge of a historic downturn? The coming months may hold the answer, but one thing is certain: the cracks in the foundation are deepening, and time is running out to prevent an economic catastrophe. Your perspective matters. What do you make of the current slightly shaky nature of the U.S. economy? Share your thoughts and insights in the comments section below. If you like this video, be sure to subscribe to Current Affairs channel and turn on the notification bell so you don't miss any of our informative future videos. Stay informed, stay engaged, and thank you for watching.